Hello, everybody, and welcome to this Global Treasury Summit. We had a great start to the session there from Simon Baptiste from the EIU, and it was interesting to hear Jonathan Ostry talk about corporate triage, and we believe that what we're going to discuss in the second half here about the use of artificial intelligence for cash flow forecasting will definitely help the winners in this triage survive coming times. So also I thought the ESG discussion from Cameron was very interesting and raised up the whole issue of sustainability, and in a way having accurate cash flow forecasts is definitely one way that we can make our companies more sustainable. So without further ado, I'm going to kick off this session on using artificial intelligence for cash flow forecasting by introducing our four panelists, who you'll see there. We have James Kelly from Pearson, a publisher. And then we have Vincent Delors from JTI, and I'll let them introduce themselves shortly. We have Nicholas Christian from Cashforce, a supplier of AI-based cash flow forecasting, and Claudia Villaris Waldorf from Deutsche Bank, who need no introduction. So those are our panelists. And before I ask our two corporates so we got a good mix here, two corporates who've used AI in cash flow forecasting in fairly different ways. And we have a provider of AI systems for cash flow forecasting, and we have a banker who's responsible for AI within Deutsche. So it's a good mix of panelists here for you today. Before I get our corporate speakers to explain a little bit about their background, I'd like to remind everybody in the audience that if you move the cursor over your Zoom window towards the bottom of the screen, you will see various buttons, but in the middle section to the right, there is a Q&A button, and that is how we will hear your questions. So please use the Q&A button at the bottom of the screen in the middle section to the right, at least on my screen. There is a Q&A button. Please use that Q&A facility to ask our questions, and I will ask them to the panelists as we go along. So I'd like to start off by asking James Kelly from Pearson, to briefly tell us about what drove you to look at AI for cash flow forecasting, and what the context is within Pearson and Pearson's treasury.
Good morning, thank you, David. So I started our project at Pearson around 4 years ago. At the time, we had a fairly decentralized treasury function, with most of the operating companies sort of performing their own cash forecasting and to an extent doing their own cash management. My background, I've worked in sort of retail and media companies for the last 10, 15 years primarily. And what I've tended to find is that while operating companies can be pretty good at understanding the drivers of performance, etc., once you come to centralize all of the data that you're getting from the different divisions, that you find it can be a little bit difficult to consolidate in a single view, because you end up with differing levels of conscientiousness. Some people are very, very careful about how much they include, and some people will sort of include the big macro pieces, but maybe not the small transactions, things like that. I also found that some people are quite positive and believe that they're going to receive 80% of their revenue tomorrow in cash terms, and some are more conservative. And so sitting in the center and trying to consolidate that and turn that into a cash forecast that you can use, particularly in the short term, can be difficult. We At that stage, we also had multiple ERPs, but knew that they were going to start to be consolidated down to a smaller number. And so I wanted to come up with a process that would suit me at the time, and also continue to be the right process as the business went through the ERP change. And so what I was looking for was effectively a system that was capable of aggregating data from a variety of different sources, that could give me a simple, coherent process that could be consistent across the multiple jurisdictions, so that I could take as much care and attention with our Swedish business, which is very small, compared to, say, our American business, which is very large. Because again, one of the things that I've tended to find in the past is that almost each currency takes a certain length of time to analyze. And so, I wanted to make sure that we could build a quick baseline model relatively simply. And so that was the start of our journey with Cashforce, as I looked for a supplier who was capable of helping us with that.
Great, thanks, James. And Vincent, you want to give a background to your project, just what the problems were and what are the drivers for your project?
Yeah, thanks, David. Good morning, everyone. So first, it's a little bit the same background, and we've been working on this project for about 3 to 4 years. And in our company, we really love to forecast. We have many different forecasts, and it's always the same people in our subsidiaries, so the local teams that are leveraged to do this forecast. And we thought, okay, we really want a specific forecast. So for us, we focused on a 12 months cash flow forecast with monthly granularity. And this process was in place for more than 8 years, I think. And the quality of the forecast, even though some entities spend a lot of time forecasting and put a lot of effort, the effort was not always translated in a good accuracy. And so we had the idea about 3 or 4 years ago to say, okay, maybe we have some statistical techniques or machine learning to achieve kind of the same level of accuracy, but spending much less time. So we started working on a small scale, even just with Excel at the beginning, just to test our hypothesis. And we already had really promising results. Of course, it was not really scalable with Excel, etc. So then we improved a lot the forecast and the tools that we use. But basically, the problem was this: we spent a lot of time to produce this forecast every month, and the quality was not always there. So we really looked for a solution that would be scalable, easy to put in place, and automatic, so that people can spend time where they really have value added, and not just forecasting months after months the same kind of metrics.
Okay, great. Thank you, Vincent. And we'll ask Nicholas now to talk about what Cashforce customers are looking for when they come to you. What are the problems they're trying to resolve, to give a broader corporate background on this?
Yeah, thank you, David. I think when it comes to so Cashforce is a cash flow forecasting and working capital analytics software provider, and when clients approach us, they typically have a variety of different issues, but it all boils down typically to trying to find an effective, efficient process to come up with a cash flow forecast with the right granularity at the right time and with the right accuracy. So, cash flow forecasting can be done for various reasons on the short term, midterm, and long term. So typically when clients, come to us, they have, for example, the challenges like multiple data sources where they would like to get their data from to fill into the forecast. So just extracting, manipulating that data is one challenge. Finally, translating that into a forecast model that makes sense for the whole business or for different parts of the business is a second challenge. Layering short-term, mid-term, long-term on top of each other. And then automating the process or putting it in a workflow because let's face it, if you're a global company, you need to coordinate different time zones, posting different forecasts with different data points all across the world. It needs to be coordinated well into a process that, let's say, not only produces a forecast, but as well measures the accuracy automatically of that forecast, and then provides feedback how, let's say, clients can optimize, or I would say, can improve the forecast going further. Because generating a forecast without, let's say, looking backwards, like how good was that forecast, is effectively not a forecast that's going to stay there. So yeah, when clients approach us, it's for a variety, a palette of different requirements that they like to improve. And maybe, let's say, linked to a last point, linked to the title of this webinar, when you talk about AI, clients in most of the times, let's say, approaches and say, hey, tell us how AI can actually improve cash flow forecasting. I'm sure we're going to talk about that a little bit further. For us, it's really one of the stones, or one of the pieces of the puzzle, and not the whole puzzle in itself, to solving cash flow forecasting.
Yeah, so there's the wider context around how you're using AI, and that we will, I know, come back to later in the discussion. Claudia, from the bank's perspective, what do you see your clients looking to get out of using AI for cash flow forecasting?
Thank you. So what we have been discussing with clients is they want an accurate prediction that they can rely on and that allows them to reduce the buffers, so liquidity buffers over funding entities. The variables that influence their payment behavior, their customer behavior, is or the demand for their products that would be input in a long-term forecast are very particular to each company and each industry. So what leads to companies now relying, as Vincent mentioned, to dozens of people working on putting this information together and extracting the data. So these people in the individual entities, they know the industry best, and they know they can identify patterns and changes in trends quite easy. And this is maybe the opportunity where artificial intelligence could play a role. While it cannot outperform humans, it can take perhaps the emotional part of the forecast. So one of the reasons why forecasts today and manual forecasts are not accurate, it's because people are afraid of making the wrong prediction. So they are over cautious when making these predictions. So sometimes they are over positive or over negative, depending on also on the time of the year when you are asking. So the artificial intelligence would take away this problem. So another issue is that when the forecast and the prediction from different people gets consolidated at very different levels, you have different contingency measures. And then at the end of the day, the number that was predicted in the same individual entity is very different to what gets consolidated. So I think this is a great opportunity for artificial intelligence to try to do what humans can do, and to learn how humans come to the conclusions that they are inputting today in their forecast process.
Okay, great. That's a good point about all the biases. As I think James also mentioned, that some of the forecasts are optimistic, some of them are pessimistic. And there's even the issue of what people's motivations are in terms of, for instance, performance assessment and stuff like that. So just to spoil the party before we even get going, I'm going to ask Nicholas to talk a little about the limitations of AI and the fact that we have a complex world out there where things that are surprising can happen and that can't necessarily be predicted from the recent past, such as what happened this year, for example. So Nicholas, tell us a little bit about those limitations before we dig into how wonderful AI is.
Yeah, absolutely, David. And I first want to make sure I echo really what Claudia says, because it offers amazing opportunities to automate a lot and to really get a grip on what humans cannot really get a grip on. I think when we talk about the pitfalls or limitations, I think they're equally important to actually realize before we use AI and machine learning, because otherwise it gets really into a hype and everyone wants to actually get started with AI, but let's say it forgets about the potential downside of that. And I think when you think about when AI and the typical examples that are given by AI in the non-business world, when games of chess are being fully automated, and let's say robots winning against other robots pushed by machine learning. We're talking about closed environments. We're talking about a closed set of rules within a closed environment, where of course the real world is very different. There are so many parameters and features at work that let's say when we run AI in business, we typically run them with specific set or a limited set of features and parameters, and we sort of forget about the other parameters, which of course creates an impact on the results, and we should always be cautious about those results. Now, concretely listing the limitations, I think first of all, a lot of the AI is based on historical parameters, historical data. If you think about the pandemic this year, this obviously truncates or pushes the data into something that you could observe after a couple of years as an anomaly. If you use historical data, it's very simple. You use as well the pandemic data, and that's important because it's something that has never been seen before in the extent like this, and it has an impact on the output results. Second is also model bias. So if it's important to see that your model can be skewed to, let's say, one version of the potential truth towards the other, just based on weight factors. Weight factors that can, for example, influence the results. Weight factors, for example, on the pandemic that might be, for example, too high or too low. So it's very important to be aware of that. The interpretation of the end result is typically not that easy with AI. We all know we have the input data, we have the model and the output data, but the model for a lot of us is pretty much like a black box. And even using some of the advanced techniques in AI, it's really highly computational, mathematical wisdom behind, and it's sometimes then very I would say difficult to actually understand what's coming out. So important to really realize that from the onset. And then data quality. I think when you're working with historical data, when all of your data points are very nice and I think proper and real and correct, then obviously it's a great scenario. But I think a lot of us are not really in that scenario when we look at historical data. Some of this historical data might contain, I would say, bad data quality to a certain extent. And we see this at Cashforce on a day-to-day basis. Bad data quality influences the model, influences the output of the algorithms. So I think to conclude, AI is amazing. It will continue to grow in terms of the importance that and the extent of the usage across systems and our processes, but it's not the silver bullet that will solve suddenly all of our problems. So if we don't apply it in the correct way, in the right context, and without taking into account those pitfalls.
Okay, great. So that's a sort of reality check, and I'm now going to ask our two corporates to explain to us how they've used AI and particularly the issues of the data sources that they're using. Just to make it clear to the audience, Vincent's forecast is a rolling 12-month business cash flow forecast, whereas James is using Cashforce to generate cash positioning. That's a few days worth of bank balance forecasts. So they are doing different kinds of forecasts, both of which are necessary for Treasury, obviously. So Vincent, tell us about your data sources and what have been the issues in getting that raw data in.
So first, I want to bounce on what Nicholas said, that data is the most important, and you cannot build a solid and robust model if your data is not clean. So I would separate in two sets of data. First, we have all the internal ones, what is produced by the company, and that is, of course, used by the company, and external data that can be found through an external service provider like Bloomberg, etc. In our model, we try to use both. So first, of course, the internal ones, such as the cash flows that we observed in the past, so our actual cash flows, but also some the different categories of cash flow. So for example, in our factories, if we get a lot of purchases, do we see that in the coming months we have a lot of output or sales, things like that. So first, we really had to clean all our data so they are all in the same form, so they can all be used by the model efficiently. In our case, it was more or less easy because we luckily we have kind of the same ERP everywhere, so it made it very easy. But some other entities, some other companies, which have different ERPs, different internal data sources, different programs, different modules, may have some issues here. But it's very important to clean the data first. And the complexity to use the real world data in our case was because, as you said, we want to forecast on a quite long term or medium to long term, up to 1 year. Here we may face geopolitical issues or the impact of unemployment, of crisis. When you try to forecast 12 months in advance, of course, this can become very, very important. And here, what the difficulty we faced here was to get relevant data in the same granularity as we wanted. So we forecast on a monthly basis and for the next 12 months. So we need data that have kind of monthly granularity. When we looked into Bloomberg, into Refinitiv, into other data sources, usually we have forecasts and actuals on a quarterly basis, for example, the GDP growth, etc. So this was a bit of an issue when we tried to implement this in our model to translate quarterly data into a monthly input. And this is why in that case, we could not really use a lot of data, external data. And secondly, when we use external data, we first try to identify the one that had a high correlation. And I'll give you one very telling example. We looked at, for example, the unemployment rate in all the countries where we operate, and we saw that we had a very high correlation between the salary payment that we had in Brazil and the unemployment rate in Brazil. So of course, the employment rate goes down, your salary increases because there's more demand, and we had a very high correlation, like 0.9, something like this. So very high. But even with this kind of correlation, so meaning you expect it to improve your model, it would not even improve our forecast for this specific category for many reasons. So it was quite difficult for us to find relevant external data that would improve our model. And so we turned to everything we could find in the internal sources. And this is where it was very important that we had all them cleaned up, all in the same format, so they could be used quite efficiently.
Great, thank you, Vincent. And James, your data gathering process was also important, right? But quite different. So maybe you could share with us how you went to get the bank account data that you need to do cash positioning.
Sure. So we started out with obviously multiple ERP systems and quite a wide variety of banks. And through the project, we've centralized down to 9 banks. We wanted to effectively concentrate to our relationship banking group. Obviously, each of those banks has their own format of sort of BAI and MT940 files, and even within certain banks, you know, different countries and different branches have a slightly different format. Our treasury management system was set up to be able to read most of those as part of our sort of day-to-day bank reconciliations, etc. And so we decided to use our treasury management system as the aggregator when it came to sort of bank account data, and then effectively feed a report out of our treasury system into Cashforce to provide the kind of actuals data. And we did a big exercise to make sure that we were coding our actuals in the same way that we wanted to analyze our forecast, so that we could analyze, you know, royalty payments, author advances, stock purchases, capital expenditure, office improvements, you know, different types of revenue, etc., so that we can really sort of analyze what the drivers are behind different areas of the business and different types of transactions. That worked really well because it allowed us to scale pretty quickly. So once we'd proved the concept in one small geography, we were able to effectively replicate the exact same process, you know, in a variety of different geographies, and move that quite quickly. So that worked really well. And using the data that we were able to get from the system in terms of the known knowns, you know, we started out, as David said, you know, the focus initially was on the first 30 days and making sure that we got a really accurate cash position, so that we could build from there and build a longer term forecast. And the great thing about 30 days is that quite a lot of your inputs are already known. So we were able to take the sales data and the receipts forecasts from Oracle in terms of sort of due dates on invoices and things like that. Sorry, excuse me. Sorry. And then in terms of the payments information, again, we could look at purchase orders and pieces that were already programmed. And then we were looking at effectively sales that hadn't happened. So our online sales, clearly, you know, we recognize the cash within a day or two of the sale taking place. So then we start to get into forecasting sales as well as receipts, which, you know, particularly through this pandemic has been interesting, because you start to bring in some of the pieces that Vincent has been talking about. You start to look at things like, you know, Google activity data and things like that in order to try and understand where's locked down at any point in time. So that's been quite interesting. But yeah, by doing all of that, it allowed us to provide a baseline, and that then meant that the conversations that we're having with the businesses are around what they do, you know, what they see changing in their business day to day, and in terms of, you know, customer behaviors. So one of the big things that we're seeing is that, you know, certain state bodies in different countries are finding that funding is either coming quicker or slower than normal and things like that. And so we kind of used that to build the first 30 days, and then we've been building out from there.
All right, so James, well, you at least had all your bank data in your Oracle financials, which
Yes.
Probably gave you a pretty good start. Claudia, can you tell us from the bank's perspective how this data issue pans out for your customers?
Yeah, so we have discussed with a couple of customers what is the problem, because artificial intelligence lives out of data. And the problem is sometimes that because of legacy, because of acquisition of new companies, the IT landscape becomes massive. So we have clients that shared with us that they have 40 SAP instances and 5 DMS systems. So creating a model for forecasting is not the issue, it's extracting the data. So if they could extract the data and put it somewhere, then they could run any model on it. Then comes the next question. So am I comfortable to taking out the data from my clients, the payment behavior of my clients, and put it somewhere outside the IT landscape of the company into a cloud? So some of them are not comfortable with that, and sometimes even regulations stop them from doing that. So data extraction and where to store it is one massive problem. So one of the solutions that they have tried to explore with the bank was if we could, with the data they have with us, if we could run a model and tell them their balances in tomorrow or in a week. The issue with that is that large MNCs have more than one bank. And if they have 5 incumbent banks, then they will have only 20% prediction for their transactions, right?
Yeah, that's definitely a challenge for a lot. Although I suppose if you talk about SME clients, for example, which maybe is not a speciality of Deutsche Bank, but in Germany, then they're more likely to be mono-banking, I guess. I just want to take this opportunity to remind everybody in the audience that at the bottom of your screen, if you mouse over your Zoom screen, there is a Q&A button which you can use to ask us questions at any time, and I'll try to direct them as appropriate to the panelists. So please use the Q&A as we go through this. All right, so data is a big issue, and as they say, AI feeds on data. So we need to have good quality data and plenty of it, and you've heard several aspects of that now. Let's move to the question of process. So in the prep call, James had a lovely expression, which was centralize the process and outsource the inputs. So sorry to have taken away your line there, but I think it's beautiful and fairly cryptic. How you look at the process for this.
So effectively what we wanted to do was we wanted to take the legwork out of the operating company's lives so that we could go to them with, the base data around, we can already see based on your sales and based on your purchase forecast. And again, as we go a little bit further out, as we go a couple of months out, 3 months out, you've already produced a group forecast, and we've started to slice and dice that and turn that into something that we can use on a day-to-day basis. So now that we've got a baseline, effectively tell us why it's wrong, or challenge it, and so it's one of those things that what we've tried to do is try to make the conversation a more commercial conversation about this is going to be better because of X, Y, and Z, or this is going to be worse because we're a bit worried about this, or this product's been delayed, or we've got this new product coming in that's an extra element to the forecast that hasn't yet been included. So that we're having that kind of conversation rather than conversations about how aggressive / prudent have you been, can we make sure that you've included, here were your top 10 receipts at the same time last year, what's happened with these customers and when are they coming. We've kind of been able to kind of dispense with all of those conversations, which is quite nice. It just means that we have those conversations within my team to try and make sure that everything's there rather than going to the operating companies. And that has worked well. And one of the big things that we find with AI is that, most people can remember 4 or 5 rules when they're producing things. So they can kind of remember, what the big customer behavior was or whatever it happens to be. But trying to apply more than 4 or 5 rules to kind of things, you have to be very systematic, and you have to go through, almost have a checklist and go through them and go, have I thought about this and have I thought about that, which is incredibly dull, fairly time consuming, and not necessarily that value added. So one of the nice things with AI is that effectively we can put all that accumulated knowledge into the system, and effectively the exercise was a great big data cleansing exercise, and also a great big exercise in sort of trying to learn as much from as many people about what goes into their forecast and what goes into their cash flow as possible, so that we kind of have this great big database of kind of all of the accumulated knowledge of Pearson on what goes into our cash balances and our cash flows. So it's been really interesting, and it's helped to kind of upskill my team. and also given us a really good and valued insight into the way that the company operates.
Yeah, so that's great because you're moving the operations, at least, from doing grunt work to thinking about a ready-made forecast, which is definitely sort of upgrading people's work life, I would imagine, which sounds like a good thing for sure. Niklas, in your client base in general, I mean, how do you see clients structuring the process around using your AI-based product?
Yeah, I think very important that the topic of the process and the structuring of it. I think certainly when take the example of the COVID crisis actually getting underway, and a lot of the corporates have really switched to doing more frequent forecasting with more, call it real time or more frequently updated data. And I think when James and I spoke around that time, I remember him telling, having that real time insight on, what was really happening, being very valuable at that particular time. So I think as a observation from our side, we've seen the importance of quicker, more real time, more data points being gathered and cleansed structurally as a very important accelerator to forecasting in general. Now, when you think about the process, it's not only about this part. So we at Cashers, we have sort of set up a 7-step process, and it's from actually understanding your actuals and your actual drivers, understanding your working capital drivers as well, and your working capital, I would say, sensitivity. And then about defining the horizons for cash flow forecasting. Why are we forecasting which period of time? And then defining different sources of data, and how to then feed these different sources of data into the different periods or the different horizons of forecasting. And then, of course, when you get the data together, it's about setting the right assumptions, setting the right logic. Just to give a simple example, if you feed in, I would say, customer invoices or receivables from the past, then of course you could forecast on a due date, but as we all know, customers don't pay then. They pay according how they basically organize their payment runs or their customer payment behavior. So let's say just putting data into the box isn't doing the thing. It's about as well making the right assumptions to the data, and then helping or letting you help by machine learning AI to predict that customer behavior, to predict when payments will go out to those vendors. Now, of course, this is getting the data all together. We forgot one step, which is the workflow around it. As I shortly alluded before, I like the suggestion of James, of course, centralize the process and outsource the inputs. And to piggyback a little bit on that again, it's about bringing all the inputs together, but those inputs will be mixed typically between system-driven data as well as manual adjustments. And we can all be dreaming about the robot bringing us the forecast, but the human mind and the business knowledge locally equally is important to amend those forecasts with adjustments. So I think when you put that all into a mix, you get to a more process-based and really structured approach. And I think I'll make one small suggestion at the end. When you think about this process, it needs to be done faster because of what we've seen in the past. It needs to work with more reliable data points. And we've observed that in the market, clients, they want to also start, let's say, by lowering the barrier. A lot of the times we asked our clients to say, oh, can you connect your ERP system to Cashforce? And obviously everyone wants that, but getting that to work with the IT people sometimes is a pain. And then lowering the barrier to say, well, you can upload data, you can manually enter data, is basically lowering that barrier. And from a process perspective, it's something to take into account, that you cannot immediately make the Rolls-Royce to work. You need to, let's say, switch cars a couple of times again before you get to the Rolls-Royce. So it's really continuous improvement the overall process that will get you to a really structured and good process over time.
Okay, thanks, Nicholas. Vincent, what does your process look like? Can you briefly talk us through that?
Yeah, sure. And it reflects actually quite well what Nicholas just said, that we also have this approach of continuous improvement. As I said, like 3-4 years ago, we started to look with the basic tools we had at our disposition. So Excel, etc., just kind of proof of concept. Then last year, we started building a real machine learning model with more advanced techniques, but still keeping it quite simple so that people could understand the concept and adhere to the process and start to really use it. And next year we will do a new phase to enhance the model where it's possible. So it's really the step up approach, and really start small, start with basic to really understand, empower your people, and then start to build on this. And regarding our process, it's again very similar to what Nicholas just said. We have every month the model that is run. So what we do is we provide the inputs. So mainly it's internal data, so the past cash flows, the open items, the date of the forecast, or your invoices with the due date, etc., to give it the most input towards the future. And then the model is run, distributed automatically to all entities. And then what we ask is all the people that are responsible for the forecast to look and let's say sanity check the forecast. So open the forecast that is already provided in the correct format, etc., and tell them, okay, don't take it as it is, just look at it, see what you can add, because maybe for whatever reason, once out of 100, the forecast can be wrong. It may happen. It didn't happen so far, but this is always a risk. We really need to sanity check, and plus add a few items that cannot be forecasted. So let's say some very let's say seldom payments. So for example, dividends. Some of our entities pay dividends, but it's once per year. It's not always in the same month, not always the same amount. So for this really specific items that are non-recurring, we ask the entities to continue to do it manually because they have more information than the model would have. Same for some tax payments, same for some business development or capex that happens just like a few times and then that's it. So the model would not be able to forecast it accurately independently. So our model provides more or less 80% of the scope, and we ask the entity that has better input to add to this model the 20% that is remaining. So our process is very automated, but it still takes a little bit of time for the subsidiary, for the people responsible to look at it and use it as a tool that still makes their life much easier because it reduces their workload a lot.
Okay, great. Thank you, Vincent. And I'm just aware of the time, so I'm going to ask all the panelists to be very succinct, but there are two important issues that came up in our prep call that I would like to cover briefly. Claudia, you brought up the issue of measuring accuracy. So why don't I ask you to talk a little bit to that issue of accuracy measurement?
This will be a very short answer, David. So what is accuracy? So when we ask our clients, sometimes they tell us, oh, we are 60% accurate. We have a great forecast. But what does this 60% mean? So does it mean that you are 40% far from actual, up or down? 60% of the days in a year, in a month? So I still haven't understood this 60%. So, but what is the right measure? And what is the right measure for a treasurer that is not a mathematician that can work with very complex numbers? So do they need like an error measure, how far from actual? So do they need a standard deviation for today? Do they need to look backwards and say 90% of the time the prediction is accurate? So I don't think there is consensus, and this is my favorite question when I go to the software vendors. So how do you measure accuracy? And as you can see, Nicholas is also smiling. So this is one of the most difficult questions. And the other thing is how the treasurers want to read it. So at the end of the day, they live with whatever they have. But if you go through the literature, you don't find the right answer to measure accuracy, I would say.
All right. So let's ask
if somebody in the audience has the answer, please send an email.
Yep, yeah, the audience, you can use the Q&A button there to give us the answer. In the meantime, we'll ask our panelists here. So James, how do you think about accuracy for your forecasts?
So the main piece that I look at is the sort of sanity checks of one, making sure that we haven't run out of money, two, that we've been able to do that in any of our operating subsidiaries, two, that we've been able to do that maintaining pretty low cash buffers. And so really I look at what level of cash buffer I intended to have and what level I ended up with. And I do that kind of across the portfolio, and I do that kind of on a rolling daily basis and sort of say, well, how far out were we overall? Because that then allows me to gradually start to slim the buffers down. So if I go back 18 months, we started out giving people relatively generous cash buffers just to make sure that we weren't making mistakes. We've been able to reduce those by about 60% over the course of a couple of years, and that's meant that the cash balances that we have overseas are much lower now. And to be honest, we're getting to the stage where it's regulatory reasons rather than anything else that means that cash is kept anywhere. But we also look at how accurate were we on timing. So to Nicholas's point, if we know that one of our large American customers normally pays every other Thursday, are we forecasting in line with that, and then how's that changing? And again, we try and look at the difference between an expected variance and an unexpected variance. So the closed loop system looks at the expected variances. This was something that we should have known. They normally pay on a Thursday and we just got it wrong, versus, oh, they've suddenly changed something. And again, that applies for, for example, Thanksgiving last week. We should know that people aren't going to pay us on Thanksgiving, that they're either going to pay a day early or a day late. Whereas there's the kind of unknowns that, somebody's off at one of our customers and they pay 3 days later because there was no one around to make the payment. So it's things like that we look at. I don't have a single measure. I have a variety of measures that hopefully tell me that the health or otherwise of what we're doing.
Yeah, I like the outcome-based approach. So Vincent, how do you think about accuracy, measuring accuracy?
So first, the model that we developed was based. I mean, this was really the first discussion. Okay, what would be the success factor? So we really from scratch defined how what we want, what's the most important metric, and of course it was accuracy. And it's calculated not on an aggregate, because we look on 12 months, but we look at the accuracy really month by month, and even more because we also forecast not only on the overall level, but we go really down to the line item. So we forecast also all the categories. So for us, the accuracy was not an issue, and we're very happy to see that the model, even with very low inputs or external inputs, it's already much better than the manual forecast, and of course takes much less time.
Okay, great. Thanks, Vincent. Nicholas, do you have anything briefly to add to that?
I'll be brief, but I'll try to be as complete as possible. So I think it's not a trivial question, not a trivial metric. I think first of all, it could be a variety of metrics. I think it depends also what you're trying to do, what you're trying to achieve. For example, are you trying to lower the buffers, like James said, on cash? But as well, are you, for example, looking to efficiently or effectively hedge your FX risk, for example, which could be resulting in other ways of measuring accuracy? I'll give one or a couple of ways. So what we do, for example, in our software, we do back tests. So what we do is we test the model on a couple of months back. When we then measure the accuracy, we're going to say, okay, on month number one, months number 1 and 2, month number 1, 2, 3, compare the forecast of the model versus the actuals. Now, of course, in both actual and forecast, you actually need to destroy the anomalies that are in the data before measuring accuracy, let's say, of a model, because otherwise you're basically, comparing apples with pears, or a model itself will typically not, forecast any anomalies itself. So again, if you're testing the accuracy of a model, you need to just leave out the anomalies. You need to understand the time period across which you measure. The time period needs to be relevant to the actual problem that you're solving. It could be a daily measurement as well, but then you're solving a daily problem and not a monthly problem. And then, of course, it's the depth to granularity, like Vincent mentioned. We typically see clients doing that if they do FX risk on the aggregate on the currency. But you could equally say, I want to make sure that we have, let's say, enough cash, but then you do it on the total cash basis. But below, there are also other accuracy measurements that you can improve, like Vincent said, on the cash flow level, on the entity level, because if you measure and you improve on that basis, your overall accuracy, of course, hopefully will also improve, the one that really matters. So it's not a trivial answer, as I said, but I think hopefully this helps.
Great, thanks. And moving on very quickly, although it's an important issue that has come up a couple of times. Claudia, you raised the issue of explainability, which I'm sure most of our audience will have heard about, but can we just talk about this in the context of cash flow forecasting and whether and how it's an issue?
So I'm quoting one of my clients. She told me that regardless of the accuracy or the metrics of accuracy, she would like to know why the model was wrong. Why was it so far away from actual? And to achieve that, the problem is that artificial intelligence cannot do it. It's one of the shortcomings of artificial intelligence. The explainability of a model is still under research. So scientists are looking at that. You have a model, it predicts something, and then one important client didn't pay when you thought they were going to pay. Sometimes a model cannot even identify this one client or this one large invoice that is affecting your prediction. So you still would need to have people that try to understand why the model was wrong. And one of the things that you need to consider when you are going to implement an artificial intelligence model is that you will need some people who start tuning the model trying to find out what's the variable or the correlation that is creating the inefficiency in the prediction.
Right, okay. So I remember that both of our treasurers actually have a process which is summarized by the central process and outsource input concept, I guess, that you ask your subsidiaries or operations to sanity check and add in stuff that the model couldn't know about. But maybe briefly, James, if you can tell me, given that you're doing things that way, has explainability been a big issue for you?
Yeah, so I'm laughing because, as Claudia explained that, the number one painful conversation I have at the moment with my boss, invoice for 22 million looks like it's going to be delayed by a week. James, can you explain, is that in the model or not? And going back and saying it's included in a bucket with a 58% probability. So almost 2/3 of it's included in the forecast, but there's another bucket that there are other things in the bucket that might compensate. I think I find that people sort of intuitively expect that you have this list of 1 million invoices and you've kind of gone through and you've coded 600,000 of them are going to be received next week and 400,000 are going to be received the following week or the following month. And it doesn't quite work like that. But so, and also, I mean, the joy of cash forecasting is that you might be out on one line, but then something else happens 3 lines further down, and your trade payables are different as well. So I try and make the art of the game is to try and keep it as simple as possible. And so, a lot of what I'm doing in terms of working capital management is trying to achieve an outcome. So if something that we had a reasonable expectation was going to happen next month is now going to happen a month later, we'll look at, okay, do we either need to accelerate it back in, or is there something else I can bring in to compensate? And we spend an awful lot of time trying to understand what's in the model, trying to make sure that we're happy with what's in the model. And then the final piece, as you've said, is around being able to explain what's happened and how that compared with what was originally forecast.
So it is a challenge. And for you, Vincent?
Yeah, so it's true. Explainability is a challenge, and every time we discuss with the forecaster or even the leadership in finance, the biggest question is, okay, what happens if it's wrong, and how will you be able to explain what happened? And really, our answer was a bit more pragmatic. So, okay, if thanks to the model you're more accurate, like 70% of the time, and this 30% of the time where you fail to foresee something you cannot explain, it's still a gain overall. I mean, you spend a lot less time and you have better accuracy on average. You should accept that sometimes it doesn't go as planned, but on the other hand, if you continue with your manual forecast, you spend much more time. And you still have these inaccuracies. Maybe, okay, you can explain them, but I would say, what does it do? I mean, if you miss your forecast, whether you can explain it afterwards or not, it already happened and the issue is still there. So for us, and I'm lucky that we had in Treasury a quite good leadership that understood this and didn't stop the project because in some cases you wouldn't be able to explain. On top of it, we started, as I said, with quite not simple, but not very advanced techniques, so we can still explain the model. If in the future we can we switch to neural networks or stuff like this, here you may have even more complexity to explain the model. But the one we choose, if we really look at the inputs, we can explain, okay, we understand why it forecasted this. It's because the trend is downward, because the previous months we had 1 to 3 million. So we can still explain it like that. But it's true, it's one of our biggest challenge. And we really answer to this pragmatically, saying, on average, you're better off using the model.
Right, so also outcome-based, really. Okay, and very quickly, Nicholas, anything to add to that on the explainability?
Yeah, I think I will echo what Vincent said. I think it's an issue. It's absolutely a challenge. As Claudia hit it on the nail, people are still doing research about it. There are actually now explainer models, so actually models that are explaining other models. Let's say that for example, we are also testing. Because then you can at least have something to put on the plate and say, hey, this is why it was good and why it was wrong. But I think Vincent mentioned it nicely. It's the leadership team that actually needs to understand this as a potential challenge for when you use AI. I spoiled the party at the very beginning, saying actually this particular downfall for AI, or a particular downside of AI. We should all realize it. It's sometimes a black box. It will not be able to explain everything. One concept that I'd like to introduce as a final note is the confidence intervals. It wasn't sort of mentioned yet during the sessions. I think James alluded to it, but if you have a certain bandwidth with probabilities, then I think you at least are closer to explaining to your peers, your bosses, what that forecast could look like. And I think with that, trying to get one step closer to the solution. Now, watch out for these explainer machine learning models, because they might be as well helping us in the near term.
Great. So thank you to the audience for attending, and a big thank you to our panelists for a very entertaining session. And I think I'd summarize this by saying that the first thing, if you're going to embark on a cash flow forecasting exercise using AI, the first thing is to be sure of what you want out of it. And the second thing would be to be aware that you need plenty of reliable data. And the third thing is that there's going to be some communication issues up and down and across the organization to everybody using and managing this data, the forecasts, about these issues of accuracy and explainability. So that was a great panel. Thank you all very much. And thank you to the audience for joining us today. And with that, we conclude the event.